Hi, I'm Sean Hanlon, CEO and Chief Investment Officer of Hanlon Investment Management. Happy New Year, everyone, and thank you for joining our 2020 quarterly research call. We'll be covering the economic overview, interest rates and monetary policy, earnings outlook and valuation, capital markets and sentiment, and information about our investment solutions. Starting with the economic overview, we view it as a 61 out of 100 possible on our proprietary economic gauge, which is favorable. This favorable reading is due to various positive contributing factors. One such factor is that the U.S. consumer is in perhaps its healthiest condition ever. The final estimate for third quarter U.S. real GDP came in at a healthy 2.1%, driven by strong consumer activity. Predictions for fourth quarter GDP have moved up to 2.2%, and full year 2019 was a winner, with GDP growth at 2.2%. That makes the 2010s the only decade in U.S. history without an official recession. And at 126 months and counting, it makes the longest expansion in U.S. history. Currently, our research sees no end in sight for sustained, yet modest, growth for the U.S. economy. It's worth knowing that major economies are not always destined for periodic recessions. Australia, for example, has not had a recession in over 25 years, and their economy is heavily reliant on the cyclical and volatile commodity sector. U.S. unemployment remains near 50-year lows at 3.5%, bolstering U.S. confidence and consumption, and the housing market in the U.S. is steady and expanding. The Conference Board Index of Leading Economic Indicators is near all-time highs, though it's been flat for the last 12 months. The individual indicators are split down the middle, with half improving and half deteriorating, so the message is not definitive and could break either way with a change in one or two readings. We view this as a neutral contributor to our economic gauge. Let's move on now to monetary policy and interest rates. This gauge is also in the favorable zone with a score of 66 out of 100. 2019 saw the U.S. Federal Reserve reverse 3 of 2018's interest rate hikes, with the most recent cut coming at the end of October to a target of 1.5 to 1.75% for the Fed funds. The Fed has correspondingly lowered its forecast for interest rates, that's the red line in this chart, to be flat throughout 2020 before rising by one hike each in 2021 and 2022. However, market-implied expectations, in orange on this chart, are still lower than the Fed estimates. As we have pointed out time and time again, the market does a better job of forecasting the Fed's decisions than the Fed does. Perplexing, yes, I know, but true, and therefore we rely more on the market's opinion than the opinion of the Fed for future interest rate direction. The market expectations have converged to Fed guidance. The blue line, the probability of no change, has risen from roughly 30% in November to 80% for Fed funds future rates through June 2020. So rates are steady as she goes right now. While the Fed is expected to keep its benchmark interest rate unchanged, it recently reversed much of its balance sheet unwind or quantitative tightening by adding liquidity in short-term lending markets, hence the steep rise on the far right of this chart. Interest rates have risen off their lows for this year, though remain low by historical standards. The 10-year U.S. Treasury has crept back towards 2% as prospects for continued growth improve and investors move into equities and allocate away from bonds. The selling of bonds has the effect of bond rates to rise. Noteworthy on this chart is that the U.S., the strongest credit quality in the world, still has the highest yield, which will keep U.S. yields from rising too far, too fast, if at all. Now let's cover the outlook for earnings and valuations, which we score as a 45 out of 100 for domestic corporations here in the U.S. basically a neutral reading. All good investors know that earnings are one of the major contributors affecting stock prices. In this chart, we show trailing 4 quarters of actual earnings in yellow vertical bars and projected earnings in purple vertical bars. The message of this chart is that projected earnings for U.S. stocks in 2020 and 2021 is up, and therefore stock prices too should have a favorable destiny. 2019 saw reported earnings growth of 6.1% for the S&P 500, and expectations for 2020 remain quite high at 15.3% growth. The S&P is trading at just under 20 times those expected 2020 earnings as of the end of last year. Not a cheap valuation by any measure. We view this as a neutral contributor to the overall market sentiment reading. Developed international markets have more modest growth expectations of 9% for 2020, yet they are trading at more modest earnings multiples of only 14.5 times 2020 earnings. Though not included in the earnings gauge, developed international would likely fall into neutral territory as well. And then lastly, emerging market earnings fell 6% in 2019, but earnings growth in 2020 is expected to be strong at 14.8%. At a P/E multiple of 13 times those expected 2020 earnings, emerging market looks attractive relative to international developed and U.S. equity markets. However, expectations in emerging markets can change in a hurry. Now let's look at our capital markets and sentiment registered just outside of the favorable category, resulting in a neutral reading at 58 out of 100. The S&P 500 index finished the quarter with a 9% return, ending near record highs above 3,200. However, the AAII Investor Sentiment Survey shows that bulls, represented by the green line in this chart, are firmly in control. This indicator generally adds value as a contrarian indicator, signaling that this view bears has the potential to forecast a pullback, making this indicator currently a negative. Emerging markets outperformed in the fourth quarter, breaking out of a downtrend since early 2018, helped by headway made on the China-US trade war and the falling US dollar. High-yield bonds also broke out to the upside in Q4 after nearly running out of steam in the late summer. The breakout was fueled by money flowing into the most speculative sector of the corporate bond market, those bonds rated CCC and lower. This was positive for sentiment, showing that investors were comfortable investing in the riskiest portion of the high-yield market after a less enthusiastic first 3 quarters of 2019 for high-yield bonds. I would like to thank you all for your time and interest and the opportunity to be of service, and we wish you a happy, healthy, and profitable 2020.